Hello and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, Lease Accounting for Energy Companies. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, and now I would like to introduce today's presenters, Jordan Whitten and Greg Kowieski, both partners here at Moss Adams. Their bios and contact information are located in your webcast console if you would like more information. And now I would like to turn the floor over to Jordan to get the presentation started.
Thank you very much. Excuse me. Appreciate everyone appreciate everyone joining us this morning or afternoon, wherever you may be. We're going to talk through leases and the standard, which has been imminent for so long and pending for so long. Certainly, there's a lot to get through here, and it's not really going to be quite the detailed dive in that it requires and is necessary. But it should be a good overview for folks to take a look at, get some free CPE, and do certainly be on the lookout. Later this summer, we will be following up with a more detailed, more extended kind of workshop where we'll take common leases across the type of lease assets and take those those leases from beginning to end through the standard and try to walk them through the assessment, the evaluation, and then accounting. So we'll go through all this. Please don't hesitate to jump in with any questions. We'll try to get through it. And if we don't get to the questions, or if you have follow-ups, please again don't hesitate to reach out. And we'll do what we can there. So appreciate you guys joining us. And sorry, I forgot that I'm supposed to click, I believe. So there's our agenda. The effective date, which has been quite the moving target. Some of our transition targets. I've actually had 2 children since the initial effective date, and we'll have another one in like 4 or 5 days maybe. So lives have changed quite a bit as the standards progressed, and really we'll talk about some of the key issues getting started on project management. Not sure where companies are at, where you folks are at with your process, and some of the challenges that we usually have seen or that exist out there, resources, and try to get through some of this accounting the key items from an accounting standpoint. There we go, 2016. So the real issue here is the SEC did a study early in the aughts, actually, about what the exposure was on off-balance sheet risk, what contractual arrangements, what liabilities were sitting there which were not recorded on companies' balance sheets. And the number came back at a concerning enough level that we find ourselves here so much later down the road. So we're going to hit our first polling question. Make sure everyone gets their CPE. I believe, Amy, I turn it over to you. Is that correct? I apologize.
Yes. So our first polling question is relating to my organization's adoption of ASC 842, our status is, and then there's several options listed below. One of them, what is ASC 842? And to respond, you will need to click the button next to the answer you choose and hit the submit button. And then if you can't see the submit button, just enlarge the slide area. And we'll leave this up here for about 10 seconds or so to make sure everyone can get their CPE. All right, here are the results.
Very interesting, very nice. I think that's pretty consistent with actually expectations. I also will learn one day what ASC 842 is, so I agree with almost 14% of you. I think that there's still a lot of work to do is pretty common. So where we're at with our effective dates, again, we've kicked this down the road so frequently, but public entities, that date has passed. Other than those as an EGC emerging growth company, you may have the ability to adopt similar to a private company. Really, one of the key takeaways that I have come away with in the last couple of months, and I would encourage you if you're interested, the AICPA Center put out their guide for plain English, effectively, and its summary says that companies have significantly underestimated the extent of the work involved in implementing the standard. The AICPA significantly underestimated the amount of work done to implement the standard, and so I think that's really one of the overarching ideas here is the AICPA had a video that said it was simple to just gross up the balance sheet, which in hindsight, and I believe it's still on their website, it kind of led to some oversimplification, a little bit of delays, certainly challenges with software, which we'll discuss as well, and really the resources to implement the standard. And all of that said, one of the big benefits for private companies is while you're required by the end of the year to have adopted and implemented ASC 842, you do not have to apply the treatment until interim periods, excuse me. You have to apply by year end, but for interim reporting, you do not have to apply the standard until next year. So that's a pretty significant benefit to really take this opportunity, kind of pull together people across a variety of departments. It does require a really wide project across an entity, multiple groups within the organization to pull this together effectively. So still time, and I think it's now the season of summer opportunity. Toyota fun. So we have two ways to implement the standard or to transition, and that's interesting that I'm not able to see one of our headings there. So our transition methods, we have these modified retrospective to each prior reporting period, which is the full restating the prior periods. That is far less common than this picking everything up at the true modified at the beginning of the period of adoption. So recording everything from 1/1/22 going forward is the option there on the right that has been, I believe it was about 78% of public filers use that approach. You would not restate prior periods. To the extent necessary, you would record an opening hit to retained earnings. That would only occur really with operating to operating leases and electing the practical expedience, you would not have a hit to retained earnings. So not overly common for adjustments to retained earnings. So the biggest issue in a lot of ways are these disclosures, substantially more disclosures required under 842. Another polling question.
All right, so our second polling question is relating to my organization's adoption of ASC 842. We expect to adopt a full retrospective. We'll get both all years on the same basis. B, modified retrospective will adopt as of 1/1/2022, or C, we're not sure yet. And then also as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. All right, most have responded, so I'm going to pull up the results. All right, here you go, Jordan.
There you go. So there, again, you see the modified retrospective far more common. It's certainly requires less effort, I would say, or assume. There certainly could be reasons for the full retrospective, and it's just something to discuss. Again, getting a lot of folks across the organization involved in that. So with our upon transition and adoption, the standard setters have been kind and offered some practical expedience and some relief. Those at the top, the first 3, are upon transition, upon adoption. Those are those one-time, elections upon adoption. The 4 at the bottom are accounting policy elections. So, those are ongoing, day 2 type items, certainly really important decisions to evaluate and consider. The transition election, the package of 3, to not reassess expired or existing contracts for if they contain a lease, what their lease classification is, and reassess capitalization of direct costs. You cannot elect only 1 or 2 of those. You must elect all 3 for all leases if you're to elect that package of 3. That is also far more often elected than not. This hindsight expedient is interesting in that you can elect to apply hindsight to the existing leases upon adoption, upon implementation, to assess, to know what you did with the lease term and impairment. So if you know you elected termination or renewal options in prior periods, you can elect that hindsight to include that in your accounting treatment, in your assessment going forward with on adoption. So that one can be very beneficial in certain situations, but is not as often elected as others. This easements one, certainly for energy companies, can be really important. Upon adoption, you're not required to assess existing or expired land access contracts, land easements, as to whether they contain a lease. So yeah, that is purely upon adoption. That is not an ongoing accounting treatment. If you enter into or modify any of those easements or acquire new ones, you are going to have to assess them under ASC 842 as to whether they contain leases. The short-term lease policy, a lessee may elect to exclude leases that have a term of 12 months or less from the commencement date. So that commencement date is not the date of adoption. That is the date that the asset is made available for use by the lessor. So if you have a 2-year contract that began in 2021, upon adoption on 1/1/22, you do not get to apply the 12-month election to that lease because upon commencement, it was not a 12-month or less lease. So they're not allowing you to shortcut it there to say as of adoption, anything with 12 months or less. As always, materiality is king. They explicitly state we don't have to assess immaterial leases. There's an accounting policy election here with lease and non-lease components that we'll get into in a little bit more detail. And then the discount rate portfolio approach, which we will also get into in some more detail. We've recently had yet another update to the standards, to the guidance for discount rates for private companies. So we'll get into that in more detail. And I know, Greg, you had some thoughts here as well.
Yeah, Jordan, the only thing I'd add, I think you covered it, but on easements, just emphasizing that there is a lot of nuance and come into play in adopting. And if you get to the answer where something is an easement, you still got to track it forward. If you change the agreement, it might come on as a lease later on. So if you have a modification, so it's just something one of the many areas to really just focus on and get your answer in place.
Another item to just note here is in order to be to qualify as a lease, which we will discuss as well, it has the contract. You have to have a period of time. So if your land easements are perpetual, that is not for a period of time. So that would not qualify as a lease. So something you see sometimes. Just wanted to note that. So, and then I think Greg, you had thoughts here on these next couple.
Yeah. And Jordan, we have a question that came in regarding private company adoption, and saying you can adopt either in interim periods or for the year of 2022, and then in interim periods going forward after 2022. And the question is, if you didn't adopt if you didn't adopt in Q1, could you adopt in Q2? And my thought on that is, like a standard would say, no, you shouldn't. But I'm wondering what the financials, what the use of them is and whatnot. What your thoughts on that?
Yeah, so it is fiscal year ends beginning after December 15th, 2021. At fiscal year end, I'm not actually, I don't believe that the guidance says that, liquidating, I assume your question there is that you're liquidating the entity on June 30th, 2022. That would not be a fiscal year end, unless I am completely mistaken, which happens on a regular basis. But to me, that's an interim period. So unless you want to early adopt as you're closing the entity, which is an interesting maneuver, I don't believe that you would have to. And if you'd like, I'm certainly happy to confirm that and reach back out to you. Sorry. Go ahead, Greg.
Yeah, and it may be the circumstances of the question may be. Okay. All right. In the section of project management and adopting, really just this slide that you see is a busy one with, we saw in the back that people are in different places with regard to adopting. If you're just getting going, think of it as a project. Like Jordan said, ASCPA has come out and said, hey, this is a big project. So go through project management on it. And one thing we've seen is, if you're going to bring in a software, work on, get that in place now, or get going on it so that you can leverage it for what it can do, and including the organization it can provide. this slide is on, again, logistics, project managing, but bringing the auditors into it. That's us. And we on our end are working with our clients to, get our arms around this, be efficient, effective, etc. But you get this, having a project plan, having whether it's a data, it depends on the extent of what you have going on with leases, but having the documents assembled, having your schedules, really maybe the documents assembled, having a memo of some form that walks down through the major sections of scoping, transition, expedience, policy, controls, having that to enable conversations with your auditors, and then underneath that having the schedules that bring it together and result in journal entries. Getting going on that internally and then working with your auditors, I cannot stress that strong enough. And this slide just lists some resources available. There's a lot of guides out there. Jordan mentioned this AFEPA sort of plain English guide. It's a really good source. And another one is, pick your favorite SEC public filers, and they have all their disclosures out there, and you can leverage those with as you go through your process.
Yeah. So something interesting here is that plain English guide has some data in it, which approximately 70% of respondents encountered difficulty in the later stages of implementation, and approximately 58% of respondents found embedded leases within their contracts. And most evaluators of that believe that 58% is low, simply by the nature of an embedded lease, right? It's something buried within a contract that you wouldn't perceive or anticipate being a lease, right? A service contract of some form oftentimes will identify the assets and grant the ability to direct the asset. And so really, really encourage you to pull together kind of recurring payments or service type contracts. I think it could be potentially dangerous or to not analyze service type contracts and just assume that they are not leases. I think that there's a lot of risk of understatement of your leases by doing so. And then also a little bit of backing up just conceptually as you're going through this. One of the key things for companies to consider is how is the adoption of this going to impact debt covenants, my current ratio? As we record these lease assets and liabilities, these lease liabilities and right of use assets, we're going to have current liabilities moving onto our balance sheet. And so what's the consequences or the impact of that? And can we get out and talk to our financiers to discuss that and address that as possible? So we're going to get into that question I believe we'll address that question so software. We'll address scope. Literally, there you go, well timed. Intangible asset software is an intangible asset. It would not qualify. It does not fall into the lease standard. And then assets under construction, inventory, biological assets, including timber. I love that the standard specifically identifies timber. And then leases to explore for or use minerals, oil, natural gas, and similar non-regenerative resources, as well as the intangible right to explore for those resources. So those are the items that are out of scope. Just be careful again with land access agreements. Regarding the additional question, there's some areas really that can potentially very commonly be lease assets, right of use assets that you almost would anticipate. Cell towers within the field. The last mile pipe could potentially or is very often considered a lease. Again, we'll get into that very specific definition, With those types of items, if pipeline agreements where you have substantially all the capacity could potentially be a lease. The most common ones, obviously, office buildings, equipment, rigs, compressors, vehicles, copiers, printers, items of that nature. But there are other items out there, and so I think pipelines, gathering systems, things of that nature. If we're receiving substantially all the benefit from that asset, then we very likely have a lease, which again we kind of are defining the definition of a lease a little late in the game here, but we'll take a look here. So there you go. You're well timed again. So right there, we have the identified asset, and that asset can be explicitly or implicitly specified. So a compressor with X horsepower, I don't need a model and a VIN number on a vehicle or anything like that. A Chevy truck is implicitly or is actually explicitly identified and implicit if it is so specialized in nature that it can do nothing other than that it is implicitly implied, or specified, implicitly implied. That's a good one. And then, do we control the use of that identified asset? So that's one that requires judgment. That's one we have to look at. And the ideas there, I love this visual. It's actually, you have to have both of these things. You don't get to go down a decision tree here. I'm not very impressed by the FASB here. No offense, please don't listening and hate me. You have to have that identified asset. You have to have the right to control the use during the lease term. We'll talk about term. Term is a vital thing to assess and consider. As far as control, you have the decision-making authority over that asset. And some of the items here are the ability to direct the use is the way it is defined. And so do we get to decide that when it runs, how much we produce, how often it runs? Do we get to decide those things that we are directing the use of? And then the ability to obtain substantially all the economic benefits from the asset, the cash flows, the production, the output, etc. As far as the identified asset, there's this little caveat here about the supplier has no practical ability to substitute and wouldn't economically benefit from substituting. This doesn't mean like they get to replace the equipment while it's being repaired or maintenance or going down. This means if the supplier, if the lessor can give you a less valuable asset to the lessor and receive the same rate and still be complying with their lease terms. So if they can give you a lower horsepower compressor and charge you the same rate, then they could potentially have the practical ability to substitute. Being able to assess whether your lessor would economically benefit from substituting that asset is a challenging assessment, and the guidance actually says if you're unable to, then assume that they would, right? So if the supplier would benefit from substituting, then you do still have that identified asset. Excuse me. And I may have been a little bit unclear on that, so please don't hesitate to let me know where I mumbled my words. Here's a pretty good visual about what this is going to look like. So we changed the word capital and created the word finance. So we're going to throw on a right-of-use asset and a lease liability. Under finance leases, old capital leases, we're going to have two expense items, amortization of the right-of-use asset and then interest on the lease liability. And then the cash flows, you're going to have your financing paid for the principal and operating for any other payments. Under operating leases, you have that same balance sheet and then one line item, on straight line basis, and everything is operating on the cash flow statement. And I might have stepped on your toes there, Greg, so you can...
Well, yeah, George, Yeah, on that one, I would just make the point regarding the finance versus operating. Just in the international world, IAS, they actually only have finance, and I think that is where sort of the FASB started, but then the operating concept developed, and here we have it. We have these two different types. So if you're in the international, they're going to be finance, and that truly does make them they're just all kind of debt-like, because it's very much a debt model. So
there you go.
You can keep going.
Okay. So when assessing the classification between finance and operating, not overly dissimilar to the 840. We don't have our bright lines, which is convenient, but it's pretty consistent with what we've seen in the past. The one down here at the bottom is new, and that is the asset is of such specialized nature that only the lessee can use it without major modifications. So this is something you'll see with solar equipment and things of that nature, solar panels or things of that nature, where that item is so specialized that it couldn't be used in any other manner. The others here, we're going to talk a lot about this, about lease term here in a moment. We're moving to term, so we'll talk about term. So under the old standard, classification is really important, right? Because if it's an operating lease, you get to keep it off the balance sheet, right? Whereas now, they all go on the balance sheet. Everything, operating, finance, all goes on the balance sheet unless the term upon commencement is 12 months or less, and you elect that policy. And that is, again, the term at commencement. Now, term is defined differently under 842, and that's where there's a lot of intricacy, judgment, and a gray area, in all honesty. It's a very, very interesting assessment that companies have to face, that specifically within equipment leases on compression, things of that nature, which are very common to the companies out there producing. We'll go with the poll question.
All right, thank you. So our third polling question is relating to my organization's adoption of ASC 842, which of the following areas gives me the most concern? A, identifying non-lease components. B, setting the lease term. C, determining lease payments. D, determining the discount rate. E, assessing lease incentives. Or F, handling lease modifications. And while you're answering that, I do want to let you know that if you would like a copy of today's slides, you can download them from the folder that says slide deck and handouts. And then we'll also be sending them via email tomorrow along with a recording of this webcast.
That's some interesting responses.
All right, here are the results.
Very interesting. So hopefully we're going to walk through some simplifications to those two of those three, the non-lease components and the discount rate. Again, the standard setters have offered companies a little relief there, fairly considerable. So we'll walk through those now. Bear with me one moment. I apologize. All right, so non-lease components. So you have an office lease. Some examples of a non-lease component would be common area maintenance, janitorial services. So a non-lease component is a good or service that is separate from that right to use the lease asset. So again, the lease asset will be the office space, which you receive the benefit of, and direct when the when your folks are working or not working and all those things, or when they're accessing things of that nature, certainly would be a lease asset. All the other features within that agreement, that contractual arrangement, need to be assessed as either non-lease components, lease components. For example, specified parking spaces, numbered parking spaces could be potentially a lease asset. It feels as though we're being pedantic. Whereas these others do not transfer the right to a leased asset. Now, initially we were supposed to apply the consideration based on the observable standalone prices, and then estimate so we would take the total consideration under the contract and then allocate it based on the observable standalone prices of the lease components and the non-lease components, and then estimate if not readily available. There is an option to elect as an accounting policy election, so not just at adoption and implementation, but then and going forward, to treat everything within that as one single lease component by asset class. So you could say for vehicles, we're going to say the right to use the truck is our lease asset, and we're going to apply the consideration to that, and we're going to say the non-lease component of maintenance, we're going to expense, and we're going to separate the lease and non-lease components. But for our office space, we're going to take everything in that contract, we're going to aggregate it together, and we're going to apply the consideration in all those payments when recording our lease liability. So you get to elect that by asset class, not have to be to all assets, to all leases, excuse me. And that is a tremendous simplification. Now, the result of electing that is you are going to record a bigger liability. That's the outcome. So I think companies pick and choose when they apply that and when they do not. Certainly see it more often elected than not.
Jordan, I would just, Jordan, that really is a good example of sort of the nuance that come into adopting. If you're gonna use the expedient and combine things, accept the larger liability or not, and if the answer is not, then you bring into play, more accounting estimates to support and whatnot with how you analyze and what you capitalize and don't capitalize. So it is making a decision about just how to be strategic for your organization, how to do that.
Yep, and the benefit of being able to pick and choose which class of assets to apply that to is genuine and is a considerable benefit. Backing up to that, just another thing, because we're going to make this all as complicated as possible. We have our lease components, which are our office space. We have our non-lease components, which are the common area maintenance and janitorial services. And then we have what are called non-components, which would be administrative services or fees which do not provide a good or service. Those non-components are applied with everything else. You do not expense those separately. They get allocated or aggregated and into our lease payments. So they have not transferred anything. They're just viewed as an additional cost of obtaining the lease asset. So here's our lease term. This is really something where I've become more bold than I already was by going in circles on this. And so we assess our lease term, and bear with me, it's basically it is the contractual period of time under the lease, as well as any periods of time, bear with me, that the lessor is reasonably certain to, got it. Ow, I'm itchy. So any options where the lessee is reasonably certain to extend the lease. So we take our lease term, our contractual required minimum is part of the term, and then any of the lessee's options to purchase, extend when reasonably certain. Plus, any lessor options to extend or not terminate the lease. So if the lessor controls the option to extend, it is presumed that the lessor will elect to extend, okay? So where this becomes interesting is you have a lease contract for a compressor that is 12 months, okay? You want to apply the 12-month policy to it. It is upon commencement, it's 12 months. But upon expiration of the primary term, absent cancellation by either party, the contract will renew for another 12 months. And then another, and the contract will become evergreen. And so you have to sit there and assess what is my actual term under this contract. And so it's a really involved process that you have to sit there and look at and evaluate the assets important to your operations, and all of these factors. Bear with me, sorry. Goodness. If we cannot terminate the lease, or if we are going to incur anything more than an insignificant penalty, then it is presumed that we are reasonably certain to extend. A more than insignificant penalty would be lost cash flows. So if we're going to lose production from not having that compressor out there, then that is presumed that it could potentially be an insignificant penalty, right? Not just a contractual penalty, not just, hey, if you terminate this or if you don't extend, you have to pay us $500 or whatever it is. You're going to have the cost to move the asset off-site, move it off your location. You're going to have costs to perhaps bring a new one on, and you're going to have lost cash flows during those periods of time. So what is your true term with some of this equipment? And to me, that's it. So if you have a piece of equipment that goes evergreen, 12 months and it goes evergreen, asking someone to assess the term of that is an incredible challenge. You know you're going to need compression, but are you going to need that compressor, right? Are you going to need that compression, that level, at that rate? And it's, to me, the key here is if both parties can terminate this with no more than an insignificant penalty, then there are not rights and obligations under the contract, effectively. So after 12 months, if I can terminate with no penalty or just 30 days notice, and the lessor can, then enforceable rights and obligations do not exist at that time. You got to assess this as far as some of that equipment may be very expensive to move, and so it's implied that you're going to keep it there. At the same time, companies manage their business by structuring contracts to where they can be mobile with moving equipment around, moving from site to site, negotiating service contracts. To tell someone that they have a 5-year compressor contract because they currently have a 1-year minimum term, but they're reasonably certain to extend that, to me, is an absurd position to take. It is sometimes taken by a few firms out there. And to me, it's really, really challenging. The FASB actually commented that reasonably certain is a very high threshold. And it's similar to reasonably assured. And they also say that the lessee is so economically compelled that they have almost no other option than to extend or to renew, right? So if you have a piece of equipment that is vital to your operations, you need to assess how long you're going to extend that contract. And once you do that, once a lease does not qualify for the 12-month exception, so once a lease is a 14-month lease or term, at no point can it be a short-term lease, okay, and then pull it off. So even if it renews for only 12 months, you do not have the ability to exclude it from your balance sheet. So you have a 2-year lease, you renew it for 1 month or for 1 year, you don't have the ability to pull it off the balance sheet at that point. It still has to go on. So that's something, that's something with a lot of nuance. It's something that I think talk through with your teams, with your auditors, and it's something that this summer we really want to dive in on when we have a bit more time to get into some details. It's certainly flying through all of this information at the moment, and I apologize for that. All right, so our lease payments.
Hey, Jordan.
Yes, sir.
I just wanted to just cut in there. I think you covered that, the term well, and the only point I would add is not regard to, hey, how long is the lease, but more like focus on, just for a second, on lease commencement. When is that? And I think, the standard talks about when the lessor makes the asset available for use to a lessee. And just a simple case where that can, come in play is like if you have a corporate building and you're going to have a lease with some kind of build out, and think through when should that lease start. And just a comment being, it matters, when is the commencement of that lease? And it matters more, in a sense, under 842, because that is when a liability and asset get recorded upon lease commencement. And so just taking care of that.
Yep. So when we record these lease liabilities on 1/1/22, we're going to take the the remaining payments, the remaining lease payments. So and use that to calculate our liability. So what are lease payments? And the lease payment is an in substance fixed payments, or an only variable lease payments based on an index or rate. So, and you would use that based on the index or rate in effect at lease commencement. So if you were to take that variable payment, use an index or rate at that time, and then a month down the road, that index or rate changes, you do not remeasure your lease liability, okay? So only fixed payments and variable lease payments based on an index or rate, you calculate that at lease commencement, and you do not remeasure based on a change in the index or rate. You only will remeasure your liability upon a remeasurement event, which we will hopefully make it to. So options and termination penalty payments are also included in here. So exercise price of purchase option, if reasonably certain, penalty payments, if we're reasonably certain, and then some residual value guarantees. So our discount rate, I know a lot of people indicated that was something that they feel will be difficult upon implementation. So you're required to use the rate implicit in the lease if you are able to calculate it, no matter what other accounting policy election you apply, because we're going to get to a nice gift from the FASB. If you are able to calculate the rate implicit in the lease, you are still required to use that. We talk about the implicit rate here. You need the fair value, the periodic payments. Certainly the lessee would have both of those things, but also the lessor's expected residual value and their deferred initial costs. That is extremely difficult for a lessee to know, and oftentimes makes it difficult to calculate that implicit rate. I don't usually see folks able to actually calculate that implicit rate. So if you do not do that, which is required, then you have your incremental borrowing rate, and then you have, as a non-public company, you have the ability to use the risk-free rate based on leases with similar terms. So you would take the 1-year treasury or similar type risk-free rate, or leases with a year, 5-year, et cetera, et cetera. So you have the ability to apply that risk-free rate to your leases based on, the similar term, leases with a similar term. And then, so to me, that should really hopefully simplify this for a lot of folks and upon implementation and then going forward. So we use that risk-free rate upon recording upon lease commencement. So the risk-free rate at the date of lease commencement to calculate our lease payments, and then we leave that risk-free rate alone unless there is a change in lease term. If there's a change in lease term, we will then remeasure that lease liability using the risk-free rate upon the remeasurement date, the date that the lease term is changed. So many ways.
Jordan, I would add in there. I think the FASB has said, and maybe you've said this, but to say it again, if a private company elects to use the risk-free rate, they can do that at the asset class level. So they could, and if for other ones, for example, they had better rates, they could do that for different classes. By class, you can make a policy decision if someone wants to do that.
Thank you, sir. Bear with me, sorry. So our risk-free rate, Greg, you want to take that one? The Fed Reserve rates are somewhere to look on that. Any thoughts on that question as far as Treasury as a risk-free rate?
Yeah, I think that's still the one we'd look to, that we'd see most likely use is Treasury. Yep.
I believe as well. And again, it would be for similar periods of time, not exact, similar. These lease incentives, they're very similar to the previous guidance under 840, and I'm not sure if you had anything here as getting a little bit tight on time, which we, again, knew was going to happen, but certainly want to get to our last polling question and a couple other items. Any thoughts here, Greg?
Yeah, no, this is, like you said, it's similar, something to see how to handle it, but keep going until we get where we need to get to.
Yep. So it's a little intricacy here. We have a lease remeasurement and then a lease modification. So a lease modification is a change to the terms and conditions of the contract that results in a change in scope. So, electing an option to extend that already existed in the original lease is not a lease modification. That is a lease remeasurement, okay? So a little bit of nuance there. I don't know why we make it so hard on ourselves sometimes, but we do. So a modification that grants an additional right of use not included in that should be treated as a separate contract and a separate lease. If it does not meet both that and the lease payment increase being consistent with the additional asset, if it does not meet both those, then we take the modified lease, reassess the classification. So here's somewhere where if we add in a renewal option or if we add in things of that nature that were not originally in the lease, then we're going to have to reassess classification. We will then remeasure using the discount rate at the effective date. Again, we record it with that discount rate. We leave the discount rate alone until we modify or remeasure. And then we record the corresponding adjustment to the asset. And then if we terminate an existing lease, then we will have a gain-loss event there. And polling question?
All right, so our last polling question is, based on past history, my organization will need to consider the lease modification guidance, A, frequently, multiple times within a year, B, occasionally, but generally at least once a year, or C, rarely or never. And then also, once you've completed all CPE requirements, you will be able to download a PDF of your certificate from the CPE progress window in your console. We'll do another 5 seconds. All right, here are the results.
Interesting. That rarely or never is interesting to me, and it may be because we're not because it's true modifications where we're not adding on right of use assets or additional, rights. We're rather extending them. I would assume that we have a lot of extensions and renewals, or maybe I'm wrong, which again happens. So, spoke about lease remeasurement. So, this is when we have assessed the lease term to be 2 years, and that's the contractual term. We do not expect, we are not reasonably certain upon commencement to exercise the option to renew, and so we use the 2 years as our lease term. A year down the road, something has happened. We'll talk about those examples. Something has happened, and we are now reasonably certain to exercise that renewal option. That's when we're going to have a lease remeasurement. Again, we will use the rate in effect at the remeasurement date, and we will remeasure that liability and right of use asset from the remaining payments under the new term. So changes in market-based factors are not do not trigger reassessment of the lease term. We only do this based on the events that are in the lessee's control. Excuse me. So if we are contractually obligated to exercise or not exercise. So again, that language about the lease term is 12 months, and as of or the lease will operate until March 31st of 2021, and then will continue until it will continue for another 12 months unless canceled with 12 months notice by either party, right? That date where we have a date to extend or to cancel is considered the event that's written into the contract. So those dates are an event, and then actually exercising that option and electing to. Electing to exercise the option means communicating it to the lessee, from the lessee to the lessor, from the lessor to the lessee. It does not mean that we had a meeting and we think we're going to do it or we're going to. We have to actually exercise the option. And then, so regarding, again, based on our time, I will circle back to you on that one, I guess, unless there are any objections, which are more than welcome. Quickly here on measurement, financial statement presentation. Again, the commencement date is when the asset is made available. The asset equals the sum of the liability and those costs. And that lease liability, again, we've really buried that here, but that is the present value of the lease payments not yet paid. So on 1/1/22 is the present value of the remaining lease payments. So want to make sure we do it that way. And again, we use the rate in the rate as of the remeasurement date or the commencement date. Again, I think we see something very similar. Yes, sir.
Hey, Jordan, I was going to say on the last slide that's right. The liability, you remeasure it, and that drives out the component of expense for the change in that, and then the ROU, the amortization of the ROU is sort of the balancing number, right? It's just the way the mechanics work of booking an entry.
Well, yeah, sorry, I was thinking of a remeasurement as in a change in lease term. I apologize. But yeah, so this one actually is going to get we'll get to some journal entries here in a moment. We kind of saw this earlier in the presentation. So we'll look at this. Here's some beautiful, I could never be an actual accountant. So here's some compressors. And we have our current liability and our non-current liability. You can see obviously that these were not overly long leases. And then so that's upon commencement date, that first entry there. And then in month one, we move some more. We move our current and non-current around. We pay some cash, and then we have. So we we record our amortization, right, our depreciation. So that right of use asset line item there at the bottom should really be accumulated depletion or depreciation, excuse me. Should be accumulated depreciation. So under an operating lease, these line items is interest, ROU liability, and depreciation of ROU asset. In an operating lease, those two lines are combined. It's only one item. It's operating lease expense. Under a financing lease, this is what it would look like. Now, this is recorded as an operating lease, so it's a straight line. We've shown that here. So it wouldn't look exactly the same if it was finance. And I think here's a good example as well of these are obviously different leases, different numbers. But you have there a financing lease, what those would look like, and then the same numbers, same payment amounts, everything, simply operating lease. So you can see the straight line nature versus the accelerated expensing there. So I have surprisingly gone over. Please don't hesitate to reach out. Appreciate everyone taking the time. It's a lot to cover, but I think, again, wish everyone the best of luck with it. Please don't hesitate to reach out. We'll follow up, and then, hopefully look forward to more exciting lease coverage this summer.
All right, thank you, Jordan, and thank you, Greg, for a great presentation today. And unfortunately, we are at time, but the slides are available in your console if you would like to download those and reference the remaining slides. I also want to thank our audience for submitting your questions to help guide the conversation. If we didn't have time to get to yours, we will do our best to follow up with you after the webcast. And then also feel free to reach out to our presenters if you have additional questions. And if you met all CPE requirements, your certificate is available to download now in the CPE progress window. And we will email a copy within 3 weeks should you have difficulty downloading it now. And then finally, here's a link to an online survey for today's presentation. And thank you for joining our webcast. We hope you'll join us again next time. Take care, everyone.